Okay, good afternoon and welcome back, everyone. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And I want to thank everyone for taking the time out this afternoon and joining us on our second webinar on our Nasdaq-100 index options. Today, we're going to talk about how to hedge a portfolio using the Nasdaq-100 index options. It's a very special webinar. I want to thank Nasdaq for having me this afternoon to show you guys this great topic. I think it's actually quite a timely topic given the price action that we've seen today with treasuries selling off, equity selling off, and really starting to see some contagion risk out of emerging markets. And I think a lot of people are concerned about potentially protecting their portfolio. I think at the same time, many people feel corporate profits are strong, the economy is doing very well, so they want to remain invested in their stocks and equity portfolios, but they want to learn how to potentially hedge their portfolios against a downside correction. So that's really what we're going to dive into and explore here today. Now, before I get started, I'm just going to put this disclaimer up here. It's basically telling you that we are not here to offer or sell any solicitation or an offer to buy any securities, commodities, or exchange-traded products. This webinar is purely for educational purposes to show you and demonstrate to you the best practices for how to go about hedging a portfolio using Nasdaq-100 index options. So my name is Tony Zhang. I'm the Chief Strategist at OptionsPlay. I'll be walking you through here today a few slides. I'll talk a little bit about what Nasdaq-100 index options are for those of you that are brand new, have never traded this index product before. I'll dive into what is a portfolio hedge, really breaking down what a hedge really means, because we talk about hedge from a conceptual perspective quite a bit, but how do you actually practically apply that to your portfolio? So what do you actually do to hedge a portfolio? We'll break that down. We'll talk about who should use a portfolio hedge, because not everyone should necessarily always use a portfolio hedge. So I want to make sure that we address that point first, because there are some alternatives that sometimes may actually be better than using a portfolio hedge. And in order to really illustrate how to go about hedging your portfolio, I want to go through some hedging examples, because when we hedge a portfolio, there's quite a few things that we need to look at. So I want to make sure we break down each one of those things, make sure you understand how to pick each one of those 5 different things that we need to look at when we're using a portfolio hedge. And then lastly, we'll wrap this up with some best practices and tips to help you efficiently hedge your portfolio using index options such as the Nasdaq-100. Now, I'll spend about 20-25 minutes on the slides walking you through the concepts of portfolio hedging as well as best practices and illustrating some examples of it. However, what I really want to help drive this home is to show you some real analysis using OptionsPlay, because each one of our portfolios are different sizes. Each one of us has different risk tolerances. I want you to not only be able to learn how to do this, but also have the tools so that you can actually implement what we're teaching you here today. So I'm going to teach that using OptionsPlay. And for those of you that don't have access to OptionsPlay, we have a free trial for you at the end that you can sign up so that you can try it out. And for those of you that already have OptionsPlay, this really teaches you how to analyze a portfolio hedge using our platform so that you can start looking at these strategies for your portfolio immediately after our webinar. Now, this webinar does require a very basic understanding of options trading. So for those of you that understand what a call or a put is, that is really the necessary requirements to utilize a portfolio hedge. Everything else we'll try to explain as we go along with respect to options. So let's start off by talking about the Nasdaq-100 index options. So before we talk about the index options, we want to talk about the Nasdaq-100 index. So the Nasdaq-100 index is the top 100 largest non-financial stocks listed on the Nasdaq stock market. And what you can trade is options on this underlying index. And there's 2 indices that you can trade depending on the size of your account. And we'll go over each one and which one you should use for your portfolio. But the full Nasdaq 100 index is a index that's roughly around 7,500 at the current levels. So that's a fairly large, it's almost like trading a stock option that's currently trading at $7,500. So it's a very large notional contract. So there's also a smaller contract called NQX, which is the 1/5 reduced value index that's currently trading around 1,500. That's really more suited for more retail focused accounts. So the Nasdaq-100 index is an index that tracks a broad-based companies that many of us hold in our portfolios, and the options on them allow us to trade or speculate on that index going higher or lower. So it's a broad-based exposure to the Nasdaq-100 index using these index options, and because we have the full value index and the reduced value index, it's suitable for all different account sizes of retail and institutional customers. Now, for those of you that have traded index options, or for those of you that have traded stock or ETF options and maybe have never traded index options, we really want to talk a little bit about what are the benefits of trading index options. Now, before I get into that, for those of you that have traded index options, can you please type index into the chat window of the webinar? And for those of you that have only traded stock or ETF options, just type ETF into the chat window, just so I get a feel for the audience here in the room. Okay, so many of you seems like you've traded ETFs. A few of you have traded index options. So the Qs, right? Exactly. Some of you have only traded stock options. So it sounds like the vast majority of you have traded stocks or ETF options, and a few of you have traded index options. So index options from a trading perspective offer some cost and transactional efficiencies, and there's some additional benefits of trading index options compared to stock or ETF options. So I'll go over a few of those. Number one, index options are cash settled. So in my opinion, what that does is it reduces transaction costs, because when something is cash settled, you don't have to worry about expiration. You don't have to worry about closing a trade before expiration to avoid assignment or avoid exercise. So what that does is it reduces the cost. So it just makes managing expiration Fridays a little easier, because whatever profit or losses you have on an index option, they're just simply settled in cash at expiration. So really easy to manage and potentially reducing some transaction costs. Second of all, it's European style. That means if you're selling calls or puts or credit spreads, you don't have to worry about early assignment, because you can't exercise a index option early, because they're all European style, unlike American style ETF and stock options where there's the availability of early assignment. No such thing exists on the index side, which also makes managing those trades a little easier. But I think, in my opinion, probably one of the most interesting benefits of trading index options versus stock and ETF options is the favorable tax treatment. There's a 60-40 tax treatment, where 60% of the gains that you have from index options trading is taxed at short-term capital gains, but 40% is taxed as long-term capital gains, which makes your effective tax rate as the highest effective tax rate you can pay on index options only 23%, compared to regular income as you do on your short-term capital gains on stock and ETF options for those of you trading in a taxable account. So you have some additional cost efficiencies by trading stocks, by trading index options versus stock or ETF options. And I saw many of you have said that you traded the Qs. So if you traded the Qs, then you've effectively traded the Nasdaq-100 index. You've just done it on an ETF. So if you've traded the Qs, I'll actually bring that up in comparison between the NDX and NQX index options in a few slides to show you actually the comparison between trading Qs versus NDX and NQX with respect to hedging. Because hedging is typically done for your whole portfolio, you're typically trading larger contracts, so you can find a reduction in transaction costs by trading index versus the Qs. So we'll jump into that in a few slides. So what I want to do is first just talk about what is a portfolio hedge. Now, we talk about hedging from a conceptual perspective. It's easy to understand. It's basically trying to protect your portfolio, but how do you actually do that? So the best way to think about a portfolio hedge is to really think of it almost like an insurance policy. You buy insurance to protect you from some kind of downside in the future, and a portfolio hedge does similar things. It's like buying an insurance, and what it does is it protects your portfolio during a market correction. So the goal here is to simply protect your portfolio if the market was to sell off. Now, how do you actually go about doing that? So what we do is we typically buy a put option on a broad-based index. You can do it on the ETF or an index option. So for those of you that have traded Qs, that is one way to do it. However, we're going to show you why the index options will provide you some additional efficiencies for using put options on the index versus the ETF. And by buying this put option, what you do is you profit from the puts as the market sells off. And what that does is it offsets the portfolio losses as the market starts to correct or starts to fall. And the goal here is to simply have the puts offset the price of the losses that you have in the portfolio to some extent. Now, it's really important to understand that when you buy a put option on a broad-based index to offset the losses in your portfolio, this creates what we consider an imperfect partial hedge, meaning it's not dollar for dollar, it's not a perfect hedge, but it does protect you to some degree the losses that you have in your underlying portfolio. Now, it's really important to understand that buying a put option to protect your portfolio, it's not cheap. It's actually quite expensive. And by doing so, what it does is it actually causes a portfolio drag from constant hedging, meaning you shouldn't do this all the time. Unlike your house insurance or health insurance where you always have that insurance policy, you don't use this on a portfolio all the time because it's expensive. If you simply just constantly bought protection or constantly bought your portfolio hedge month after month, quarter after quarter, you might end up paying more on the insurance policy than you actually gain on your portfolio itself. So it's really important to understand when to enter one of these hedges, and we'll discuss that in a few slides. So because of all of these things, this requires active management and timing with respect to a portfolio hedge. So those are some of the things we're going to dive into today, as to how to actually manage and time a portfolio hedge. So I just want to illustrate for everyone what a portfolio hedge really looks like. Sometimes charts is a little easier to understand. So here is your stock portfolio. Pretty easy to understand. As you see, you have dollar for dollar exposure to the stock market. If the market goes higher, you get profits to the upside, unlimited profits to the upside. And if the market goes lower, you have unlimited losses to the downside. Now I say unlimited, but technically you can't lose unlimited, because when the market goes to zero, that's the most you can lose. But we typically think of that as unlimited risk, because the market falls to zero, you lose everything in your portfolio. So this is your portfolio unprotected currently today if you don't have a hedge on. So what does a portfolio hedge look like? This is where we buy a put option on an index or ETF. Any of you that have traded puts before is probably familiar with this chart, where you have unlimited profits as the markets continue moving lower and the put option increases in value. And as the markets go higher, you have cap losses or limited risk to the put option that you've purchased, because the amount of money that you risk on a put option is the amount that you pay for that put option. No matter what happens to the market, you will not lose any more money than you've paid for the put. So how does your portfolio look when you combine your stock portfolio with this put option that you buy? So this is what a hedge stock portfolio looks like. What it does is that you have your stock portfolio, but what you've done is you've bought a put option on the index or ETF. And what this maintains is actually still your unlimited profit upside if the market continues to go higher. So you still participate in your capital appreciation as the markets continue going higher. However, if the markets go lower, you have cap losses, meaning you have limited losses as the market goes lower. And the whole point here is to protect yourself beyond a certain point so that you don't lose any more. Or if the market goes all the way to zero, or if the market crashes, you don't lose all of your money in your portfolio. That's the goal of a portfolio hedge. So who should use a portfolio hedge? And this is really, really important before we move on to the mechanics of a portfolio hedge and what to look for and how to set one up. Because we talked about a portfolio hedge as an imperfect partial hedge. It's never going to give you dollar for dollar protection to the downside. However, there is a such thing as a perfect hedge. And for those of you that have the luxury or the ability to do so, you should do that before you should consider a portfolio hedge. A perfect hedge is simply moving your stock portfolio into cash and then reinvesting it after a correction. So for those of you that have the ability to simply sell your positions, move it into cash, and then wait for the markets to correct and then buy back again, that is by all means a much, much better hedge than buying a put on your portfolio. However, that's not always possible. Some of you, maybe you own stocks and you want to maintain those positions because you hold some stocks where you rely on the dividends for income. Perhaps you have stocks that you've owned for a very long time, and if you sold them into cash, you would generate a huge tax bill, and you're not ready to pay that tax bill yet. For whatever other reasons, perhaps you just want to remain invested in the market and you're not willing to move into cash yet. So not everyone has that luxury, and if that's the case, that's when you should consider a portfolio hedge. But I want to reiterate, for those of you that have the ability to move your money or some money into cash and then reinvest it later, that is a much better hedge for your portfolio. It's free, it doesn't cost you any money to do that, and it gives you dollar for dollar hedge. So keep that in mind. When you're considering a portfolio hedge, it's only for when you don't have the ability to move your assets into cash and then reinvest it later. So who should use a portfolio hedge? This is for any investor with a portfolio of stocks or ETFs. So many of you probably own stocks or ETFs in your account, and you are looking to protect yourself against a correction greater than 5%. Now, I say 5% because in recent years, we've seen corrections happen fairly quickly and fairly violently. So meaning what we're seeing is that it's really difficult to protect yourself against a 2 to 3% correction or even 4 to 5% correction, because as you can see, a single day like today can wipe out 2% off of the equity markets. So a single day sometimes is not enough time to consider entering a hedge. Sometimes you want to see the market correct a little before you get to that trade. So we're really looking at protecting yourself when you're expecting the market to correct greater than 5%. And lastly, like I said, this is only for those of you who do not wish to sell any holdings or some of your holdings. So again, for those of you that have dividend paying stocks, or you don't want to pay that tax bill, or you just want to remain invested because you think there's still upside in the market. And I think a lot of people still feel that there's quite a bit of upside still left. Corporate profits are strong, the economy is strong. There's reasons that still remain invested. However, I think it's pretty clear that there's a lot of downside risks as well. And I think this is really why this is a very timely webinar for a lot of people, because you want to remain invested, but you're concerned about what should I do to the downside if the markets do correct. So now that we've talked about what is a portfolio hedge and when you should utilize it, let's now talk about the actual strategy itself. Now, like I said, managing a hedging strategy requires active management and timing. So I want to break down what are the things that you need to look at when you're considering a portfolio hedge, everything from timing to the instrument you use, to expiration dates, to strike prices, the number of contracts, and really break down each one so that you're very clear as to how to go about selecting the appropriate hedging strategy for your portfolio. So number one, like I said, because hedging is not cheap, it's quite expensive, it's really important that you time your hedge as quickly with a market correction and get out as quickly once the market correction is over. So it's generally best practice to time your hedging strategy when you actually see a correction starting to happen. So enter a hedge during a correction, meaning it's better in this particular case to enter it during a correction than to try to anticipate it. Because if you're anticipating it, you're paying for a hedge, that hedge may not never materialize, and you end up paying quite a bit in protecting a portfolio against a correction that doesn't come. So it's really important, in my opinion, to wait when you enter a hedge as opposed to try to anticipate it. As opposed, when it comes to exiting a hedge, this is really when you want to exit a hedge as soon as you feel that the correction is over. Or for those of you that are a bit more familiar with looking at fear indices like the VIX or the Nasdaq VIX, you're familiar with volatility peaking very quickly, and then it forms this very sharp peak. So when that volatility peaks, those are usually good times to exit a hedge. So these are the types of things that you want to look for. Entering a hedge when you feel the market is starting to correct, and exiting a hedge as soon as volatility peaks. That's usually a good indication of it's time to get out of your hedge. So now that we talked about timing a hedge, what do you actually use to pick, what do you actually buy? What put option do you buy for a hedge? So this is really where it's best to pick an index closely correlated to your portfolio. So most of you probably have portfolios that have a well-diversified stock portfolio. If you have a well-diversified portfolio, any index such as the Nasdaq-100 broad-based indices is usually a good place to start with hedging your portfolio. If you have a tech-focused portfolio, Nasdaq-100 index is perfect for that type of hedging because Nasdaq-100 represents a very large share of technology stocks by market cap in the market. However, if let's say you own a bunch of banks in your portfolio and that's the only stocks that you have in your portfolio, then it's important that you look for an index that's maybe a banking index or banking ETF. So making sure that you pick an instrument that's closely correlated to your portfolio is really important. Most of you will have broad-based portfolios. For those, the Nasdaq-100 index is a good starting point for you to look at for hedging your portfolio. Now, when it comes to portfolio sizing, which I will get a little bit more in depth on the next slide, that really depends on the size of your portfolio to help you decide which one of the index options are suitable for you. So we talked about the NDX being a $7,500 index, which means that the notional value of each contract is $750,000. So it's really suitable for portfolios that are greater than $1 million. For those of you that have portfolios smaller than that, you might want to consider the NQX, which is around $150,000 notional contract. So this is really useful for portfolios greater than roughly about $150,000 to $200,000. So making sure that you pick the right instrument, not only the right index, but also the right instrument of the underlying index is also important. And I think we'll highlight that here in the next slide. So how to calculate the number of contracts that you should use to hedge a portfolio. The formula is actually quite simple. It's not complicated at all. You just simply take the portfolio value that you're looking to hedge, divided by the index value, divided by 100 because each contract is 100 shares, and that tells you the number of contracts that you should purchase in order to hedge a portfolio. Now, for those of you that are looking to hedge a part of your portfolio, maybe you only have 50% of your portfolio in stocks and 50% in real estate, right? So then what you really need to worry about is the equity portion of your portfolio. So even if you have $1 million portfolio, but if only half of it is in stocks, you only want to apply that $500,000 to that portfolio value in this formula. So I created a chart just to give you an idea as far as, roughly the number of contracts that you would trade depending on what instrument you're using. So like we said, the Nasdaq-100 is a suitable index for those of you that have broad-based diversified portfolios. But the Nasdaq-100, you can trade the ETF, which is the Qs. Many of you are familiar with trading this ETF. You can trade the NQX index, which is roughly at 1,500, or you can trade the NDX at 7,600. These are all based on the exact same index. So they'll give you very similar downside protection. It's just that because there's different values to each ETF, you're going to require a different number of contracts. So if you have a $200,000 portfolio, you would have to trade 10 contracts of the Qs to hedge your portfolio versus only a single NQX to hedge your portfolio. So this is really where it gets into transaction costs and slippage. You want to buy the smaller amount of contracts because then you have to pay fewer or smaller commissions. So this is really where, as you can see, as you grow, as your portfolio grows, you're going to need more and more contracts. So as you can see, at $200,000 and $500,000, you want to probably use anywhere from 1 to 3 NQX contracts. And as you get into $1 million range, as you're protecting $1 million portfolio, that's when you want to consider starting to use the NDX value, because at a $5 million portfolio, you would have to use 32 contracts of NQX versus only 6 contracts of NDX. So making sure that you select not only the right instrument, but also selecting the right number of contracts is really important. And it's quite simple. You take the portfolio value divided by the value of the index, divided by 100, and that tells you the number of contracts you should trade to hedge your portfolio. Next, I want to talk about expiration dates. So I think the two pieces that most people are asking when it comes to buying a portfolio hedge is what expiration date and what strike price should I use? And the answer here is because portfolio hedging is fairly expensive and you're effectively buying a put option which puts you at exposure to time decay, this is really where it's better to buy longer dated puts. Even if you're only in the hedge for a couple of weeks, you still want to buy a longer dated put because of time decay. As you can see with monthly options, the time decay is much slower than when you buy a weekly option. So even if you only expect a correction to play out over a few weeks, you don't want to buy those weekly options because they're going to decay in value much, much faster. And that's going to help, and that's going to offset the gains that you have in your hedge. So you always want to buy longer dated options, usually at least 2 months or longer. And the goal here, again, is to minimize time decay. You can buy a 3-4 month option and only hold on to it for a few weeks and sell it. You don't have to hang on to it for 3-4 months. So keep that in mind. And when you're buying these 3 to 4 month options, you're minimizing time decay. So you have less money that you're losing on the hedge to time decay than you are when you're trading a shorter dated option. So really important to use longer dated options when you're using a portfolio hedge. Next, this is where it gets, when it comes to choosing strike prices, this is really where it depends on your views on the underlying market. So just like health insurance and car insurance and house insurance, you can buy different levels of coverage. Same thing with selecting strike prices. The strike price you choose will help you determine how much coverage you have. So if you're looking for just for a catastrophic protection, meaning only you're looking to protect yourself against a major downside correction, you're really just trying to protect yourself against that kind of black swan event, that's really where you want to buy out of the money puts. Usually somewhere around a 30 to 40 delta is an appropriate place to start when you're buying an out of the money put to protect yourself. And usually this will cost anywhere from 1 to 3% of your portfolio value to buy this type of catastrophic downside protection. Conversely, for those of you that are looking for more comprehensive coverage, for those of you that are looking to basically protect yourself from any movement to the downside, that's where you want to look for in the money puts. So anywhere from a 50 to 60 delta is usually a good place to start. Now, this will cost you anywhere from about 3 to 5% of your portfolio value. So as you can see, it's substantially more expensive to buy comprehensive insurance than catastrophic insurance, which is the case just like any other insurance policy that you would have to buy. So what I want to do is I want to actually illustrate the difference between these two, and that's really the key here today, is to help you guys understand the difference between these two and helping you decide which one's best suited for you depending on what your views are for the market and what type of protection you're looking for. So I have a hedging example here for catastrophic coverage. This is talking about buying a out of the money put option. So the theoretical portfolio that I have here is $1 million portfolio, and for that I'm going to use NQX as my index to the reduced value index as the index that I use to buy insurance policy on it. So this is looking at I'm looking to buy 7 contracts, because if you take $1 million divided by the 1,500 index value divided by 100, you're going to see that you need approximately 7 contracts to protect your portfolio. I'm looking at a 2-month 30 delta put. Cost me roughly $17,000. So on $1 million portfolio, my put cost me $17,000. So 1.75% of the portfolio value in order to protect my portfolio. And what I have here is I've illustrated a few different places that the market can go and what your portfolio will look like. Now, this is a chart just for illustrative purposes. I'm actually going to flip over to OptionsPlay in a few minutes and show you these with some real numbers so that it becomes a little easier to understand. But as you can see, as the market continues to fall, and when the market falls 5% and the portfolio loses $50,000, $100,000, and $150,000 as the market falls, as you can see, some of that losses is offset based on the options hedge. So, and as you can see, what happens is as the market really falls, that loss on the portfolio, instead of growing bigger and bigger, stays fairly constant around $50,000. So my catastrophic insurance will basically prevent me from losing more than roughly about $50,000 if the market really falls lower. And this is really, when this is trying to protect yourself from a black swan event. You're afraid that the market's going to collapse 20% over the next few months. You're not sure when, but maybe this is the type of catastrophe that you're trying to prevent against. This is where a catastrophic insurance might make sense. And in the case that the market doesn't correct, and the market actually moves on higher, you lose the $17,000 that you've paid for the hedge, which nets you $32,000 if the market does move 5% higher. However, I think what's important to note is that even if the market stays flat, you're still going to lose that $17,500 because that's what you paid for your put option. So a very important thing to understand is that as the market moves lower, it's really only going to protect you when the market makes a big move lower. And it does, and the cost of it is relatively minor compared to the overall cost or the overall value of your entire portfolio. Next, what I want to do is compare that with a comprehensive coverage, so more expensive put option. This is what we're talking about, the same 7 contracts, but instead of buying an out-of-the-money put, we're going to buy an in-the-money put, a 60 delta put. This now cost me $36,000 instead of $17,000, so more than double what it would cost to buy a catastrophic insurance. But as you can see, that looks quite different. So number one, even if the market stays the same, I'm actually only going to lose $16,000 out of the $36,000. Unlike the other one where I've lost the full puts that I've prayed for, because I'm buying a put that has intrinsic value, it actually still has some value if the market stays exactly where it is. So when the market stays exactly where it is, the two portfolios, whether I buy comprehensive or catastrophic, even though the comprehensive costs a lot more, will actually look roughly the same. Now, as you can see, as the market goes down, that's really where the two differ quite a bit. So as the market moves down $50,000, $100,000 to $150,000, the most here I lose is about $15,000 because I've bought this comprehensive insurance that protects me almost very close to dollar for dollar for my losses, which gives me a much better protection to the downside. So this is for those of you that are looking for more comprehensive coverage. As you can see, this costs 3.6% of my underlying portfolio value as opposed to 1.7. But as you can see, as the market moves lower, I get much better coverage. The only time when this really underperforms is if the market continues to move higher and I don't get the move that I expect to, and let's say the market moves 5% higher, I'm going to lose all $36,000. So my net portfolio is only up $13,000 as opposed to $37,000 or so roughly with the catastrophic insurance. So these charts are really just meant to illustrate for you very quickly the difference between the two. I think this will become a little bit more clear once I show you some real examples using OptionsPlay. So before we move on to OptionsPlay, just very quickly, I want to talk a little bit about best practices and tips for hedging. So we've talked about what is a portfolio hedge, how to go about doing it, what are the different things that you need to decide in order to enter a hedge. Now I just want to talk a little bit about some of the best practices and tips, just so that for those of you that are brand new to this, hopefully helps you get into these trades a little easier. So number one, constant hedging is not cost efficient. So we've talked about hedging as a way to protect your portfolio, and I think most people will agree that when the market corrects, a hedge makes sense. However, constant hedging is not cost efficient because it costs you 1, 2, 3, 5% of your portfolio to just buy a hedge for a couple of months. If you bought it all the time, you would end up paying more in hedges than you would actually get in the appreciation of your portfolio. So it's not something that you want to do all the time. So timing is one of the most important things when it comes to hedging your portfolio. And this is really one of the cases where it's better to be late than early. Because you want to enter that hedge once the market correction has actually started, so you're sure that you're getting the protection when you need to and you're not buying protection when you don't need it, which typically happens when you anticipate a hedge, when you anticipate a market correction happening. It may never materialize and you may end up paying 2-3% of your portfolio just to anticipate that. Usually not worth it. The second tip that I want to give users is that because hedging is quite expensive and not very cost efficient, one of the things that you can do to offset the cost of hedging is to sell cover calls on the stocks that you own in your portfolio. So if you have a portfolio with 10, 15, 20 different stocks in it and you're buying an NDX or NQX put option to hedge your portfolio, you should at the same time consider selling some covered calls, because by selling covered calls, you're basically saying you don't think you're concerned about the market correcting, you're concerned about the market falling. So you can sell covered calls, fairly aggressive ones even, to offset the cost of buying that hedge. And that's really something that a lot of traders typically do when they're using these hedging instruments. And it's actually a strategy that you should consider at all times, even if you're not hedging. It's to sell covered calls, generate premium, because that premium really can help offset the time when you do need to hedge your portfolio. Next, index options really provide cost efficiencies compared to ETF and stock options. So you can certainly buy ETF options, giving you very similar types of protection. You do need to typically purchase many, many more contracts if you're trading those ETF options, but you don't get some of the efficiencies such as the tax benefits of trading index options, as well as not having to deal with expiration and just simply cash settlement. So if the market does correct 20% and you're in the money and your put that you've purchased is in the money, you don't have to worry about closing it out. You just simply, the profits that you receive from that put option on the index will be settled in cash, and that will simply go offset the losses that you have in your portfolio. So usually a little easier to manage when it comes to portfolio hedging. And lastly, this is more so in, based on the illustrative purposes that I'll show you guys with OptionsPlay in the last couple of slides. The in-the-money puts provide better protection during a portfolio hedge, during a market correction, because you typically want to use hedging as a you want to enter a hedge once the market has started a correction, such as today. Today is probably an interesting time to consider looking at a hedge. I'm not saying that the markets are going to continue moving lower. I think it's a little earlier to tell that. But if the market keeps correcting for the next few sessions and really starts to move beyond that 5% from the peak, that's when you want to start considering taking a look at these hedges. And because at that point you're fairly confident the market will continue to correct, that's where buying in the money puts, even though it costs more money, will give you far better protection on your portfolio. Even if the market doesn't continue to correct, even if the market stays where it is, those in the money puts many times will provide you with similar protection as those catastrophic puts. But if the market does severely correct, you get much better protection. So with that, what I want to do is actually want to bring up OptionsPlay. I want to show you some real examples to show you how you can plug in your own portfolio and be able to look at and analyze some hedges and compare what we're talking about here today. So what I'm going to use is I'm going to use NQX, because I'm guessing most of people on this portfolio, on this webinar, do not have $5 million, $10 million portfolios they're looking to hedge. I bet most people have smaller portfolios. So I'm going to use NQX, which is a bit more focused for retail customers. But if you have a large portfolio, you certainly can still use NDX for the purposes that we're showing you here today. So what I want to do is compare the portfolio with two different hedges. I want to compare a catastrophic hedge and a comprehensive hedge. So what I'm going to do is I'm going to modify these expiration dates. So we talked about using relatively longer dated options. So I'm going to select the January 2019 option. And what I'm going to do is I'm going to use a January 2019 put option. First, I'm going to select one that's, and I'll do the same thing here, but I'll do a January 2019 put option. So I have two put options, but before I select my strikes, what I'm going to first do is I'm going to first select what my portfolio value is. So let's say I have $1 million portfolio. What this does is it allows me to calculate the appropriate number of contracts that I can purchase. So as you can see, this is telling me to purchase 7 contracts of the put options, 7 contracts of the put options against $1 million portfolio here. And what I'm going to do is I'm going to actually fiddle around with the strikes a little to get to an in the money strike. So let's say I purchase a out of the money strike that's let's say 2.5% roughly of my portfolio value. So I have $1 million portfolio. I've picked a put, the 1430 puts, which is about $70 below the current price. That cost me $25,000, so 2.5% of my total portfolio value. Versus what I'm going to do is I'm going to pick an in the money strike, maybe one that costs maybe double that, so roughly $50,000, $49,280. So the catastrophic insurance that I'm purchasing cost me 2.5% of my portfolio value. The comprehensive one cost me $50,000, 5% of my portfolio. And what I want to do is illustrate how your portfolio will actually perform based on different scenarios that can occur in the market. So first, we're going to start off is what happens between now and January expiration. The market stays exactly where it is. So as you can see here, even though this cost me $25,000, first of all, my portfolio would basically be flat. The catastrophic insurance that I buy, I'd lose everything, the $25,000. On the comprehensive insurance, as you can see, I also lose roughly $25,000. Even though this cost me double, because this comprehensive coverage gives me in the money options that has intrinsic value, if the market stays where it is, I actually lose the same amount of money as I do if I buy the catastrophic insurance. And I think this is a really key thing to consider when you're deciding which one's better for you. Are you trying to protect yourself only against the black swan events of the downside, or are you concerned about a fairly small correction as well? Or maybe even if the market stays flat, how do these strategies perform? Conversely, what happens if the market starts moving lower? So as you can see, if the market starts moving lower even by 5%, here on the portfolio, you lose $50,000, 5% of your portfolio. But as you can see on the catastrophic insurance, you lose an additional $18,000 because this is part of the problem with catastrophic insurance, is it only protects you in a large move, and a 5% move simply isn't large enough to protect you. So your net result is you actually end up still losing more than what you had purchased if you didn't even buy insurance to begin with. Because if you didn't buy insurance, you lose $50,000, but if you bought insurance, you lose about $68,000. Certainly not necessarily the scenario that you're looking for. Conversely, if you bought the comprehensive insurance, you actually gain $27,000 back out of the $50,000 that you lose. So now your net loss is only, instead of $50,000, only about $23,000. So this is really where this comprehensive insurance starts to pay off very, very early. Even in a small correction or shallow correction, you're going to get some protection with that comprehensive insurance. As you can see, if the market continues to move lower, let's say the market now moves 10% lower, so now I've lost about $100,000 on my portfolio. This is when the catastrophic insurance starts to kick in. As you can see, I've made $34,000 on my catastrophic put insurance. So now out of the $100,000, I gained $35,000 back. So I lose about $65,000 net at the end if I bought this cheaper insurance. Versus if I bought the comprehensive insurance, I make $80,000 back. So instead of losing $100,000, I'm gaining $80,000 back. So my net is only $20,000 loss. So this is really, again, where you want to help, depending on how much you want to pay, where you think the market is going to go, that will help you decide using this P&L simulator to see exactly what your expected losses or gains would be on your portfolio, and see that, if the market really tanks, how much protection do I get from each one of the different insurance policies? And conversely, what happens if the market stays where it is, or even what happens if the market takes off? Because that's always a possibility that the market ends up taking off. Let's say it goes up another 10% instead of going down. So here you made $100,000 on your portfolio because it went higher, but you lost $25,000 on the catastrophic insurance versus $49,000 on the comprehensive insurance. So you've actually lost either a quarter or a half of your gains if the market does shoot higher. So this tool is really designed to allow you to pick the different scenarios as to where you think the market might be headed, and allow you to really take a look at, so what happens if the market goes back down to 1391, which is where it was just a few months ago. As you can see here, if the market goes back to 1391, you lose $70,000 in your portfolio, but you gain $48,000 back on the comprehensive insurance versus only $2,000 back on the expensive, on the cheaper insurance. So this is really where you can play around with different scenarios as to where you think the market might be headed, and allow you to compare the two different strategies and different hedges. You can play with the different expiration dates, you can play with the different strike prices, and really start to see where you're going to get the best return for where you think the markets are going to go. And you can utilize this you can use our risk and investment calculator. You can plug in any size portfolio. So let's say you have, instead of $1 million portfolio, you have a $400,000 portfolio. you can do the same thing. And now we're only going to buy 3 contracts instead of 7 contracts. So it actually automatically calculates for you how many contracts to buy, and it really allows you to compare what you make or lose on your portfolio versus how much you would gain back on your insurance if you bought either one of these 2 put options. So with that, that wraps up what I want to show you guys here today. For those of you that have never used OptionsPlay, we do have a free 30-day trial for those of you that are looking to test out this platform that we're showing you here today. That includes options education webinars like the one we're doing here today, as well as daily option trade ideas, and it's available for you at optionsplay.com. So with that, what I'm going to do is I'm going to open this up for Q&A. For those of you that have any questions regarding anything that I explained here today, please type them into the chat window, and I will answer as many questions as I have time for here to answer any questions you might have with respect to buying a hedge on your portfolio. So I have a few questions here that are already queued up. I'll start answering those questions that are here. $64,000 question becomes, when does the market go down? Just like today, there was no indication yesterday that such a correction was imminent. That's exactly my point, David, is that you don't want to try to anticipate a hedge. You only want to enter a hedge when you're actually starting that correction. So that's really where you don't have to anticipate, you don't have to know that the markets are going to correct. You just have to wait for the markets to correct before you enter one. That's what I meant by it's better to be late than early, because you only want to enter this hedge once the market has started to correct. And you can do that catastrophic or comprehensive insurance, but you don't want to do it until the market has started to correct. So like I said, even today, in my opinion, is certainly a time to consider looking at these type of strategies. But I don't think a one-day correction is enough to say, hey, it's time to start hedging your portfolios. I usually like to see at least a few days or a few sessions of continued selling and more risk, as to, or more indication that that's likely going to continue happening. Right now, this was really fueled by a little bit of, the sell-off in treasuries. There's some risks in Italy with the Italian bonds right now, but still fairly contained at this moment. There isn't anything imminent that's necessarily causing a huge sell-off in the market. So this is, hedging, you may only have to do a hedge once a year, or if even that. Sometimes you might have to hedge multiple times a year depending on how volatile the year is. But this is a webinar designed to really help illustrate and educate you so that you're prepared for when you do need a hedge. Because like I said, these down moves that we've seen recently, they've been pretty violent and pretty fast. So it doesn't give you necessarily a lot of time to react. So it's really important that you have these concepts understood and fine-tuned before you need it, because once you need it, you might have to execute on these pretty quickly. Are put spreads cheaper hedging idea? So yes, absolutely. So great question. Richard's asking, can you buy a put spread instead of just buying a put? Now, the reason that we generally don't use put spreads on a hedge is because put spreads only protect you down to a certain amount, right? When we think about hedging, we're really entering these hedges because we're usually concerned about a big move lower. If you're just concerned about a small move lower, sure, you can use a put spread, but generally speaking, moves to the downside are pretty violent and pretty quick. And when they happen, a put spread just simply doesn't provide the same level of protection as a straight put does. So that's why, generally speaking, we use puts instead of just put spreads. Any downside for using index fund versus ETF? So the only downside, in my opinion, is the size of the contracts. Meaning, if you have a portfolio that's only $20,000, $30,000, then the index options may be too large of a contract. But if your portfolio is over $200,000, I think between the efficient transaction costs or lower transaction costs, the tax treatment, everything else, there's a very good reason to trade index options versus the ETF. JB is asking, why don't we hedge using SPY? It's broader protection. So I think SPY and NDX are both very viable possibilities for broader protection. They're both broad-based indices. Like I said, any broad-based indice will provide you with it. But the reason that we want to use index options is because of the tax treatment, because of the cash settlement, which makes it easier to manage around expirations. Can we get a copy of your charts? Absolutely. So I will be sending out a copy of the slides with the recording after we're done here today. What would you please state again how to sense a correction is imminent? Again, I wouldn't do this to try to sense a correction is imminent. I will only do it while you're in a correction. So today might be the first day of maybe the first day of a start of a larger correction. Hard to tell. We'll have to see what happens tomorrow and maybe the day after to see if the markets really fall significantly lower. But really, you have to look at the fundamental reasons behind why markets are selling off. That's usually a better understanding as to whether a correction will continue to worsen or not. Think about the 2007, 2008 financial crisis. That was all, fueled by mortgage-backed securities and the fact that we were loading ourselves on debt that couldn't be serviced, right? So there was fundamental reasons for why the market corrected as far as it did. So those are the types of things that you want to look out for. Which hedge do you prefer, index ETFs or VIX ETFs? I wouldn't use either one. I would use index options, in my opinion. VIX ETFs, I don't think is a good hedge at all. There are lots of reasons why you should not consider using a VIX hedge that I'm not going to get into in this webinar. It's just too much to look at the very moment. But I highly recommend that you use a broad-based index. Whether you use an ETF or an index is up to you, but use the underlying index itself. Buying puts on those underlying index is a much, much better hedge than trying to trade VIX ETFs or index options. The spreads are wide on the options. Should you shoot for the midpoint as your purchase price? Great question. You're absolutely right. Sometimes the quotes on the screens are quite wide, but that does not mean that there's no liquidity. We are talking about an index that has tens of billions of dollars under management. These are very, very liquid indices. So you can put in orders in between the bid-ask spread, and you will typically get filled much closer to the midpoint than you will actually get filled at the bid-ask. So very good question. I highly recommend you to take a look at placing limit orders inside that spread, because you will see that you can get filled well inside that spread. Using today as an example, if one were to bought an NDX put, would it have guarded one's loss? Absolutely. That's exactly what we'll do. So here, let's go back to the example, right? Let's say what happens by tomorrow. Let's say the market drops to 1440 tomorrow. Let's say you get another big down day tomorrow. What happens? As you can see, if you had a $400,000 portfolio and the market drops 3.76%, which is down to the 1440 level, you lose $15,000 in your portfolio. If you had bought the cheap insurance, you make $3,000 of that back. So a decent hedge. I mean, you certainly not, in my opinion, a great hedge, but you certainly make some money back. If you had bought this more expensive put option, you make $10,000 of that back. So instead of losing $15,000, you only lose $5,000. Or if you had bought the cheap insurance, instead of losing $15,000, you lose about $12,000. So this is where you can use OptionsPlay to really see how much protection you would actually get from even a one-day move like we saw today. David's asking, do contra ETFs have any benefits in this scenario? In order to act when the correction is in progress, sometimes not possible if you are not checking your portfolio several times a day, which almost becomes like day trading exercise. If you're referring to contra ETFs as in inverse ETFs, those inverse ETFs only provide the inverse protection on a single day, meaning they're not multi-day protections, versus the index options give you, weeks, month-long protection. That's why we almost never use those VIX ETFs or these inverse ETFs, because they only provide you with that type of protection that one single trading day. That's kind of one of the reasons why we saw that huge blow up in February, was because of these. A lot of people were using these inverse ETFs and not really understanding how they're constructed. So definitely take a look at that. You don't want to necessarily use some of those inverse ETFs. They do protect you on an intraday level, but they don't protect you any longer than that. What is the cost of service for this? It's $50 a month or $500 a year for OptionsPlay. I've been following the NDX since the last webinar, and we've noticed that the difference between the bid-ask prices on both bullish put and bearish call spreads can differ substantially from the last trade price. How would you suggest one enters a trade in order to avoid overpaying? So I wouldn't necessarily use the last price as an indication, because last price could have been a few hours ago. You don't necessarily know that the last price was, within the last few minutes. So you always want to put your orders as close to the mid price as possible. That's usually where I'd like to start. I usually start at the midpoint, start moving my prices a little further away from the midpoint, and you continue to do that until you get filled, and that gives you an indication of roughly where you can get filled on a spread. But usually some of the rule of thumbs that I start off with is 20% of the way between the mid price to either the bid or the ask price. That's usually where I start my limit orders, is 20% of the way. Michael's saying, I'm just trying to get my head around the strategy. For example, if the market goes down, do you exercise the put? You don't. So one of the great things about the index put options is that, or any put option rather, is that if the market, let's say this market goes down to 1440 tomorrow by October 5th, and these are your profits on the puts, right? So you can, at this point, if you feel that the market is done correcting and you're ready to stop the hedge, you simply sell the put option and you would realize roughly this amount of profit. So even though you still lose $15,000 on your portfolio, you can sell this put and make this much profit. And that helps offsets the cost of the losses that you have in your portfolio. Conversely, for index options, if you held it all the way till expiration, let's say the market, on January 18th, 2019, the market is at 1440. You lose $15,000 on your portfolio, but what ends up being settled in cash in your account is a $10,000 loss or a $5,880 profit. And that's just simply cash either debited or credited from your account that gives you this type of return. So you simply just receive cash. And that's, again, one of the benefits of trading index options versus ETF options, because if you're trading an ETF option, you'd have to sell that put. You'd have to either sell it at a profit or potentially have to exercise it. So this, you don't have to do any of that. You can just hold it on with the expiration and settle in cash. But if you expect that the correction is over before expiration, you would sell the put options for that profit. Do you suggest to use SPX January option for hedging? What was the reason SPX went down 40 points and turned 16 point positive? So I'm not going to comment on to what actually happened intraday. That's not really what we're here for this webinar. I'm happy to answer any specific questions you have regarding the market. If you want to send me an email at info@optionsplay.com, I'm happy to answer any questions related to the market. But that's not what I want to spend the time here on this webinar to talk about here as to why the market sold off and came back intraday. The bid-ask spreads are wide. I think I've already spoken about that. You mentioned moving to cash doesn't cost you any money. Are you assuming a fee-based account with transaction costs included? Well, okay, when I say there's no cost to selling, there certainly is a cost, but that cost is minimal compared to the $10,000 or $20,000 that you'd have to pay to buy, a put option. So yes, you might have to pay a few $100s in commissions to sell your cash into your or move your assets from stocks to cash. But those are still minimal compared to the $10,000 or $20,000 that you're paying in buying a put. So from that purpose, it's not completely free, but it is very close to free compared to just buying a put. Once a hedge is necessary, the premium increases in the cost of the options becomes difficult to acquire at a decent price. How does one have a backup strategy going out further? So again, this is really where, yes, it will get more expensive, but as you can see, this put option is much more expensive today than it was yesterday before the sell-off happens. But the goal here, again, is not to buy protection as cheaply as possible. That's not the goal. You're never going to be able to buy protection as cheaply as possible. If you do that, you're likely going to buy protection when you don't need it. And that's my point, is that only buy protection when you need it. It's going to be expensive. That's my point about timing. It's going to be expensive, but as you can see, even though it's expensive, it's well worth it if the market does continue to correct. So that's the point here. We're not saying that you can buy protection really cheap. That's exactly the point of those webinars. That protection is expensive, so you want to make sure you understand exactly when to buy and how to go by doing it as efficiently as possible. What is a 30 delta put? Delta refers to the if you ever looked at an option chain, you can see this is roughly a 30 delta because we have 3 contracts in it. That's $91. So delta is just telling you the probability of this put being in the money at expiration. So January 18th, 2019, the 1430s have around a 30% chance that this put will be in the money. So how far down, the further down you go in terms of strike prices, the lower the probability, and that's what delta tells you. Could you send a replay of this? Yes, this webinar is recorded, and we will send out the recording as soon as we are done here. David, your question about the daily play, that's getting a little off topic for this specific webinar. I'm happy to answer that question, but send me an email at info@optionsplay.com, and I'm happy to answer your questions regarding the daily play. JB's using, can you use a collar for this? So you can, however, I wouldn't recommend doing that because your collar is not actually collared, because if you were to sell a call against this, let's say we sold a higher call. Let's say we sold a call against that. As you can see, because you don't actually own the NQX index, this is not a covered call. This is actually a naked call. So that's why in my slides, I suggested that if you want to offset the cost of buying that hedge, you want to sell covered calls on the underlying stock itself. So your stock portfolio, let's say you have 10 different stocks in that portfolio, you're not technically collaring it, but what you're doing is you're selling covered calls on the individual stocks, and then you're buying a single put option on the index itself to protect you. This is better than buying 10 different puts on 10 different stocks, because that obviously has a lot more transaction costs, and it's obviously going to be much, much harder to manage. Any other questions regarding hedging your portfolio? Michael, thank you very much. I really appreciate it. For those of you, if there's no more questions, I just want to thank everyone for taking the time out this afternoon. Again, for those of you that have never used OptionsPlay, you can sign up for a free trial and test out what we're showing you here today at optionsplay.com. Any last questions? Richard, you're very welcome. Bob, you're very, very welcome. I'm glad that you guys have found this informative. That's really what we're here for, is to help educate you guys on understanding these strategies, making sure you have the tools to also exercise these strategies when you're ready to do so. Like I said, this is not necessarily something that you use every day, but it is something that's very good to be prepared for when you do need it. And sometimes it just takes a few times to practice it, looking at your portfolio, comparing it to a few different hedges, so that when the market does sell off, you're prepared for it and you're able to execute on it confidently. Any last questions? If not, I just want to thank everyone for taking the time out this afternoon. I hope you guys find this useful. We will be back here in about 3 weeks with another webinar on Nasdaq-100 index options. It'll be the 3rd webinar in our series. We'll be covering technical analysis and trading directional strategies. So I hope to see all of you guys there in a few weeks. Thanks and have a great afternoon.